Hey guys, how's it going? This is the second part of our financial statement analysis series. Today I'm going to be showing you guys how to analyze a balance sheet. I'm going to be showing you what everything in the balance sheet means, and then I'm going to be showing you how to use all this information to actually analyze companies and find companies that could potentially be good investments. I'm also going to be showing you how the income statement and balance sheet link together so you can have a better understanding of businesses and their financial statements. Before we get started, could you guys just gently tap that like button down below? Just gently tap it. And if you're new, you might as well also hit that subscribe button to not miss out on videos like this. Before we actually go into the balance sheet and look at some numbers, I wanted to give you guys the basic conceptual overview. Let's say you want to start a business and you want to start a business selling cookies. You're going to need to fund this business in some way. You're either going to fund this business with equity or with debt. Equity can be seen as the money that you contribute towards the business. So you want to start your cookie business and you invest of your own personal money $100,000. You then have $100,000 of equity. You think you'll need $200,000. So you take another $100,000 of debt. If you were to do this, your balance sheet would look something like this. You'd have around $200,000 in cash, you'd have $100,000 of debt, and your equity statement would be $100,000 for the amount of capital that you contributed. Now that your business is funded, you want to use this money to buy assets to be able to actually make and sell cookies. You decide to open up your own store for $50,000 and buy machinery and ingredients for your cookies for $25,000 each, converting your cash into assets. Your first year running your cookie business goes really well and you make $100,000 in profit. You can either take this profit and keep it in the business and reinvest it, or you can take some of this money out to live on. Since this business is your only income stream, you decide to take out $50,000 in the form of a dividend. A dividend is just a payment to the owners of a business. The money left in the business is known as retained earnings. The retained earnings can be found by taking the net income or profit and minusing dividends paid. This is the money that is retained within the business over the business's lifetime. The retained earnings goes in the equity section of the balance sheet. This $50,000 in retained earnings also has to go somewhere in the assets section of the balance sheet. Let's say we collect $25,000 of cash and $25,000 of accounts receivable. Accounts receivable is just the money that is owed to a business that hasn't been paid yet. Now the balance sheet is balancing and the world is in perfect harmony. That's the basic overview of how a business works. You can finance your business with equity or debt. You then use the money that you have to buy assets. You use these assets to actually run your business and to actually earn a profit. The balance sheet just shows you what you own and what you owe at a specific point in time. Now that you guys have a conceptual overview of the balance sheet, we can now compare the balance sheets of Netflix and Viacom, the two companies we analyzed last time. One easy way to find the balance sheet for a company you're interested in is to search Yahoo Finance and the name of the company. You then click on Financials and Balance Sheet. While Yahoo Finance is a good source, sometimes data can be missing or some data could be incorrect, and it is a better option to just go directly to the SEC's website. All you have to do is type in sec.gov. You then scroll down and enter the ticker symbol of the company that you want to find. You can then click on their 10Q or 10K. The 10Q is their most recent quarterly report, and their 10K is their most recent annual report. Both of these documents will have their financial statements, and if you scroll down, you'll eventually find the balance sheet of the company. This is Netflix's balance sheet from their most recent quarter of June 2020. A balance sheet just shows you what a company owns and what it owes at a specific point in time. What it owns is known as its assets, and what it owes is known as its liabilities. Assets and liabilities can be further broken down into current and non-current assets and liabilities. When you hear current assets or current liabilities, think within the next 12 months. Current assets are assets that will be converted into cash or used up within the next 12 months, and current liabilities are things that need to be paid within the next 12 months. And when you hear non-current, think longer than a year. The non-current assets are the long-term investments of a company that it'll use for longer than a year. And the non-current liabilities are the things that the company owes that it'll only pay at some point in the future, at least after 1 year. Current assets include cash and cash equivalents, as well as what they call other current assets. These are considered the most liquid assets, which just means they can be easily converted into cash. As we can see, Netflix has around $7 billion in cash and total current assets of around $8.5 billion. If we want to find out what the other current assets actually are, all we have to do is scroll down and we can find out a lot more information about different items on the balance sheet. In Netflix's balance sheet, we come to a section called Balance Sheet Components. We can see that other current assets is located here, and we can see that trade receivables make up around $565 million. Then there are prepaid expenses for $204 million and other for $640 million. Trade or accounts receivables is just the amount of cash that a business is owed that hasn't been paid by its customers or clients. Other current assets could include prepaid expenses, which are expenses that Netflix has already paid for but haven't been used yet. Netflix may have paid a studio to film one of their new releases. The film may have not been recorded yet, and this is why it's known as a prepaid expense. The film will eventually be recorded, but Netflix is just paying for it upfront, and this is counted as a current asset. This is one of the reasons why if you're going in depth in a company, you would want to use the SEC filing, because on Yahoo Finance, you wouldn't be able to figure out what the other current assets mean over here. Now we're moving on to the non-current assets. Since Netflix is a streaming service, they make money from people subscribing to their streaming service where they provide movies and TV series. Because of this, a lot of their non-current assets are actually content assets, or the content of the movies and TV films that they have licensed or produced. Netflix has around $25 billion of content assets, which just means that all the TV shows and movies that they've licensed or produced is worth around $25 billion. If we want a better in-depth look at that, we can go into item 5, balance sheet components, and look here at the content assets. So we can see that Netflix has licensed around $15 billion of content. From other media companies, Netflix has licensed content, which means that Netflix has bought the rights to be able to show those films and movies on their platform. Netflix has also produced content and is currently developing content worth around $10 billion. Netflix also has property, plant, and equipment of around $750 million. This would include mainly Netflix's offices that they have and own, as well as data centers for their streaming service. Netflix also then has other non-current assets of around $2.7 billion, meaning that their total assets is around $37 billion. Netflix is a classic technology business because a lot of their assets are not actually physical, they're in the form of content. An oil and gas company or a manufacturing company would have a lot more assets in property, plant, and equipment. The next section of the balance sheet is the liabilities and stockholders' equity section. And for the balance sheet to actually balance, the liabilities and stockholders' equity have to equal to the assets. As we can see, Netflix has around $4.6 billion in current content liabilities. This is the amount of money that Netflix has to pay to other companies for producing their content and for licensing content within the next year. Netflix also has around $446 million of accounts payable. Accounts payable is just the money that Netflix owes to suppliers that they haven't yet paid. And the next item is accrued expenses and other liabilities. This includes the expenses that Netflix has built up and not yet paid for, and could include things like taxes, interest, rent, and utilities. The last two items are deferred revenue and short-term debt. Deferred revenue is just the revenue that Netflix has earned but not yet provided services for. This would be, for example, a customer buying a 1-year membership but only being 6 months into the membership. Netflix's total current liabilities are around $7.6 billion, with current content liabilities and deferred revenue being the biggest. Next up, we have Netflix's non-current liabilities. This includes their non-current content liabilities, which is around $3 billion, and their long-term debt, which is around $15 billion. That is a huge number, but I think it is reasonable for Netflix because they do have such a huge growth potential, and even though they do have to pay this money back at some point in time, they are growing really fast, so I don't think it should be a problem for them. However, in general, you should be wary of companies that do have a lot of debt. Netflix has total liabilities of around $28 billion. This is a lot smaller than their $38 billion in assets, which is a really good sign for their financial strength. In general, you don't want to be investing in companies that have more liabilities than assets, because this means that they are in a poor financial situation and could potentially go bankrupt. And the last section of the balance sheet is the equity statement. The equity section shows you how much of the company all the shareholders own. It shows you how much of the company would be left over if all the assets were sold and converted into cash and used to be paid off all the liabilities. Another way to think about equity is the amount of capital that the owners of the company have contributed, plus the retained earnings that the company has earned over its lifetime. But essentially, the equity section just shows you how much of the company all the shareholders own. From this, we can see that the business owners have contributed around $3 billion, and the retained earnings is around $6 billion. The total equity is around $9 billion, and the total liabilities plus equity is around $37 billion, which is also equal to the total assets. Now that you guys understand the basics of the balance sheet, you want to bring in the company's data into our spreadsheet so we can compare them. Now we have this information for both companies, we can look at different metrics to see how the companies are actually performing. One metric is the current ratio, which takes the current assets and divides it by the current liabilities of a company. A ratio of above 1 shows that a company is in a good financial position for the next year because it shows that they have enough cash and assets to pay off their liabilities for the next year. Both Viacom and Netflix have a current ratio above 1. The second ratio is debt to equity. This shows you how the company is funding itself, whether it's using more debt or more equity. A higher debt to equity ratio shows you that the company is using more debt, which could mean that it has a higher potential to go bankrupt in the future. Ideally, you want to be looking for companies that have a debt to equity ratio below 1, because this shows that their equity and debt levels are relatively similar, but the debt to equity ratios will vary by industry. And since Netflix and Viacom are both in the same industry and both have ratios above 1, it doesn't seem to be such a troubling sign. Other ratios to look at include return on equity and return on invested capital. To calculate these ratios, you also need to look at the income statement data. To get the return on equity, what you have to do is you have to take the net income that a company makes. So for example, in 2019, Viacom made around $3.3 billion. So we take that number and we divide it by the total equity within the company. In Viacom's case, we get a number of 22%, which is really high. The higher the return on equity, the better. The return on equity can be used as a measure of financial performance to show you how well a company is doing. Return on equity will differ based on the industry that a company is in, but to know if a company could be a good investment, you want to make sure that it has a return on equity higher than many of its peers or its competitors, as this gives you an indication that maybe the company has a competitive advantage. Another important metric is the return on invested capital. This also shows you an indicator of how well the company is performing, and it's found by taking the net income and dividing it by equity plus debt. If a company has taken on a lot of debt, the return on invested capital will be a lot lower than the return on equity. When analyzing a company, you want the return on equity and the return on invested capital to either be rising, showing that the company is improving, or if the company is already established and has a competitive advantage, you want the return on equity and return on invested capital to be relatively stable. Looking at both the return on equity and return on invested capital for both Netflix and Viacom, we can see that both of these companies do perform very well. The interesting thing that I found by analyzing Netflix and Viacom is that even though Viacom outperforms Netflix in all of these financial metrics, it has a market cap of only 17 billion, whereas Netflix has a market cap of around 200 billion. This is mainly, like I said last time, because of the huge growth that investors see in Netflix. The real question is that growth worth 230 billion? And another interesting question, is Viacom only really worth 17 billion, or are they actually worth a lot more and currently undervalued? And remember, this is not financial advice, but in my personal opinion, I do believe that Viacom is undervalued and potentially does have a lot of room for upside if they're able to get their streaming platforms to scale, which will allow them to start growing revenues and earnings a lot faster. Thank you guys so much for watching this video. I really hope this video has helped you guys understand balance sheets and businesses a lot better. If this video has seemed a bit confusing and all of this analysis does seem like a lot of work and you personally don't want to do it, don't worry, don't give up on investing. There is still something that you can do. You can become a passive investor and invest in ETFs or funds that can be used to track the global stock markets, so you can still get the benefits of investing without having to analyze individual companies. I would highly recommend, if you feel that way, to watch my video on how to build an ETF portfolio, which I'll link to you guys now on screen. Remember to hit that subscribe button if you guys don't want to miss out on videos like this, and thank you guys so much for watching. I'll see you guys next time.